Good afternoon, everybody. This is Jody King with the Alaska PTAC, and I want to welcome everyone today. And I especially want to welcome our speaker, Chris, with Business Insurance Associates. I always mangle his last name, so I will let him introduce himself fully. And we're going to talk about insurance risks and contracts. However, before I turn it over to Chris, I just want to do a quick call everyone's attention to the GoToWebinar panel. We are a small group today, so I'd really like to encourage questions and have a great discussion. I do want to let everyone know that this is being recorded, and hopefully we'll have this after Chris gets a chance to review post-event. And if he agrees, then we'll go ahead and post this information on our website. A lot of good information today. If you have any questions, you're welcome to click on the raise hand feature and I can unmute you from my end. I'm going to go ahead and leave everyone muted now. There's also a question box where you can type in your questions if you have any questions. Again, as a small group, let's go ahead and have that conversation and get the most out of the information. So Chris, I am going to go ahead and turn it all over to you. The command is yours.
Thank you, Jody, and happy to be here. Always like the work that PTAC does and do anything that we can to help support that. I always encourage a lot of newer contractors or contractors who might need some resources to go over and see the folks at PTAC. They do a great job with people and putting on educational type opportunities and information. So I appreciate the opportunity to be here. My name's Chris Pobieglo. And Jody, if you want to kind of remember how to pronounce the last name, I always tell people to remember it rhymes with San Diego. Pobieglo, San Diego kind of gives you a reference point there. But
that's a good hint. I keep wanting to throw lots of extra L's in there.
The L's actually silent. So Chris Pobieglo, and I'm with Business Insurance Associates. I've been doing this for about 20 years. Both of my parents were brokers for 30 years, so it's something that's been in our family a long time. And like my parents, who also kind of specialized in contracting, insurance, and risk, that's kind of been one of my main focuses over 20 years. We work with a lot of different clients and, assisted living and transportation and a lot of different industries, but the construction industry has always been my love. I grew up here in Anchorage. I went to East Anchorage High School. When I first got out of high school, I worked in the construction industry for a period of time. So I enjoy that line of work. I enjoy working with contractors, and we take what we do very seriously. We're protecting company assets and the things that people have, in many cases, spent years building. And so the insurance piece of it and managing that risk for a company is a critical part of that. I am a former president of the Construction Financial Management Association here in Anchorage, or CFMA. Still involved with that group, which is bankers, accountants, insurance people, controllers, anybody who has a vested interest in construction accounting. That is a great local group to get involved in as well. So encourage everyone to look into that. We're members of AGC, ABC. We've done presentations and participated in various activities that those associations put on. So we do everything we can to support the industry. I'm a certified construction risk insurance specialist with the International Risk Management Institute, which is fancy for saying I took some classes and might know a thing about construction risk management and insurance. So that's who I am. I'm happy to be here, and so we'll go ahead and get started. As Jody mentioned, if you have any questions along the way, feel free to interject, or if you have any information or knowledge that might be beneficial for anyone tuning in, please interrupt or raise your hand or access the chat feature, and we can address those as we come across them. So we're talking a little bit today about insurance and risk that are in contracts. Obviously, let's see here, let me try to make sure my screen's not, there we go, okay. So we're talking about insurance and risk and contracts today, important topics. makes a big difference in how those contracts are executed, how the company is protected. And I'll just kind of break it down into mainly 3 categories that we'll look at, which will be the basics of risk management, which these basics and these principles should be always at the front of your mind and guiding your decision-making process when you're reviewing contracts and determining where your opportunities are going to be. We're not going to get into reviewing the entire contracts today. We're going to focus on the insurance requirements and the indemnification portion of those contracts. If you want the whole contract, that's probably something better for your attorney. There's a lot of important provisions in those contracts, as you well know, payment provisions, performance obligations, dispute resolutions. There's a lot of things in there that you have to be able to review. We mainly confine our review to the insurance section and the indemnification, which is within our realm of expertise. Anything beyond that, you kind of get into the legal realm. And we always, as a best practice, recommend all contracts, leases, any legal agreements be reviewed by a qualified attorney to make sure that they're addressing some of those. So we'll look at some of the basics of risk management, and then we'll look at some of the different parties that are involved in these contracts and how their interests are protected and addressed in these contracts. And then we'll go through and look at a few sample insurance requirements that that you may run into and that may stimulate a little bit of a conversation. So we're going to talk about basics of risk management. There's probably more of these basic principles, but these are the ones that I like to focus on because I think they're really critical. And anytime you're reviewing a contract, or really for that matter, anytime you're doing a business activity, if you're expanding into a new territory, if you're taking on a new scope of work, there's a lot of different risks out there. And so these are principles that should be applied to all of those circumstances and part of a regular process that you go through. And so the first one talks about never risking more than you can afford to lose. And sometimes that means passing on a contract. Not all revenue is good revenue. When I sit down and talk to a contractor who's been around for 20 years, they can tell you about that job in great detail they had from 13 years ago where they lost money. These things tend to stick in people's mind when you have a bad contract or something goes sideways, and hopefully you learn lessons from it and there isn't anything too painful. But again, it goes back to don't risk more than what you can afford to lose. Kind of self-explanatory, but important. We talk about don't risk a lot for a little gain. So on your margins, what is this contract? How much risk are you taking on? What does it mean for your company? And at the end of the day, what are you going to be compensated for taking this risk? Because we all know that anything you do is going to create risk, but you can't sit in the basement and not do anything in the hopes of avoiding risk because you also eliminate all your opportunities. So risks have to be taken. They just have to be identified, calculated, and managed appropriately, including the risks that you find throughout these contracts. Risk is not always self-evident. You're going to have some that are. You have a snow berm outside your front entranceway. That may be very evident, but there's a lot of risks that aren't evident, and some of them may be in these contracts. And so the message is to dig for risk. You want to have a strong risk identification program. I'll jump down to the last bullet point on there, which says that risk identification is the most important step, and I'll come back to that in a second. But having a strong risk identification program is important for finding those risks out there that aren't self-evident. Some of that is going to be in those contracts. And then this is an important point. There's no such thing as an uninsured loss. And what we mean by that is you may have a corporate insurance company who's handling your insurance program, and If you have a loss or a claim and they don't cover it, either because it was excluded or because it just wasn't the type of exposure that was contemplated under that policy, if they don't cover it, then you cover it. So in a sense, as the owner of the organization or the contracting company, there's no such thing as an uninsured loss, because if the insurance company isn't covering it, you've become the de facto insurance company. And I think sometimes uninsured loss tends to, not properly attribute where that there's a cost to be paid, and that cost is going to be borne by the contractor covering it. And then another important point, risk is present in every business activity. When you sit down and you sign a contract, you go and send a crew in to remodel a building. If you're building a road, if you're hiring an employee, if you're driving a vehicle, these are all business activities that are creating risk for your organization. And so it's important to, to keep that in mind, that risk is going to be present in every business activity. It's important to identify it and move through the process from there. Next point we make is that risk is subject to diagnosis and treatment. In short, that means you have the ability to do something about it. When you identify those risks, there's options and strategies available for you to handle. How do you go about managing this risk? Loss control things, safety related things. So it's important to know that you have some control over that process and mitigating losses and mitigating risk to your organization. A combination of risk identification techniques should be used. And what that means is you're digging and you're looking to identify risks, and there's a lot of different techniques that can be used to do that. One of them, as we're talking about today, is review of your contracts and your leases and your legal agreements. Those all have risks. You can send me a contract and I'm going to look through it and I'm going to be able to identify numerous risks out of that contract that the organization is going to face. So that's one step, reviewing your legal agreements, your contracts. There's a lot of other ways you can identify risks. You can conduct interviews with your staff, your internal personnel. A lot of times they're privy to various risks that you as the organization head, who might not be in the day-to-day of that activity, may not think about. So talking to your staff and the people on the that are there with you is another good way to identify risks. You can do inspections. Physical premise inspections are always a great thing, whether it's your office, your shop, whether it's your job site. You can do physical premise inspections. Those will identify a number of risks for you. You can review your insurance policies. Those are a great way to identify risk. You want to jumpstart it, go to the back of your policies and start digging through the exclusions, because every single exclusion that's attached to your insurance policy, it may or may not be a risk, but it's certainly something that the insurance company is not covering, as it's obviously on an exclusion. So review your exclusions. Those will help you identify risks as well. You can bring in outside consultants. There's safety consultants, there's HR consultants. They can help you identify it. Your accountant, your CPA, your banker, they can help you identify some of the financial risks. So a lot of different tools available. And let me add too, if anybody, I may reference some different documents or things at different times. If anybody wants anything that I mentioned during this presentation, you can get a hold of PTAC and they can get you my contact information. My email is Chris, CHRIS, and it's a long one. It's at businessinsuranceassociates.com. Chris at businessinsuranceassociates.com. If you want any documents or anything I reference, just shoot me an email. I'll be happy to share those for you. We have a whole list of various risk identification techniques that an organization can use. So I've talked about a few of them, but that's available if anybody wants that. So I want to mention that. And Then the last one, again, the risk identification is the most important step. If you don't identify a risk, you can't develop any strategies to control it or to transfer it. You've got a number of strategies available to you. You can transfer that to an insurance policy. You can retain and manage that risk. You know, I always tell people insurance is not the answer for everything. There's a lot of things that you can do on your end to manage risk. And maybe sometimes it makes sense to transfer that risk to an insurance policy. Maybe sometimes it doesn't. But that can be determined in this risk management process. The key is just to identify the risk. You can avoid the risk. We talked about a minute ago how not every contract is a good contract. There may be contracts out there with onerous terms or obligations on you that just may not make sense. And so that may be something your organization decides, you know what, risk avoidance is a strategy for this case. So let's move in that direction. You can sometimes pool risk, you can sometimes segregate risk. So there's various things you can do with that risk, but it's really important to identify it. And going through the contract is one of the huge and most important ways to be able to go ahead and identify some of the various risks that you might face. Got just a short cartoon here, and it kind of goes to the point of, you know, the lady says, why do you have only 40% of an umbrella? And the guy says, well, the chance of rain is only 40%. And so to me, it really gets to the question of what dictates your insurance program for your organization. Are you setting up your insurance and which policies you cover or you hold and what limits you put based on a contract requirement or based on what someone else tells you should be done? Because the reality is that your insurance program should be set up based on the risk management decisions your organization has made. Which ones do we want to transfer and what's it going to cost us to do that? So it's set up based on what your risks are. Here's one example I'll give, and I'll talk a little bit more about this in a few minutes, but you have pollution coverage out there. Typically, your general liability policies are going to exclude pollution coverage. There may be some cases where you can buy back a little bit of limited coverage, but it's a lot of times for the folks who might need this type of coverage, it's a specialty line and you may have to secure a separate policy for it. Now, in the past, there's been, it's been pretty standard that hasn't been required in a lot of contracts in the past. A lot of times people carry it if the contract requires it. If the contract doesn't require it, they're not going to carry it. But it really avoids that key question of, do I have the risk? If I'm taking dump truck loads of sand through sensitive environmental area, I probably have a pollution risk there. Now, whether or not my contract requires I carry the pollution coverage, that's another story. But the reality is you may have the risk out there, but the contract isn't necessarily requiring you address it through an insurance policy. So be careful when you're setting up your insurance programs and, you know, the decisions you're making, that those are based on the actual risk that your organization faces and not based on what someone else is telling you that you need to have in place. Another example might be the state licensing or state regulations. Some cases, here's a perfect example. It's not necessarily applicable to a business, but it paints the picture for you. On personal auto coverage, the state of Alaska requires you carry 50,000, 100,000, 25,000. To me, as an insurance broker and someone who's handled claims and seen the outcome of what happens, that state minimum limit is woefully insufficient. I wouldn't recommend anybody out there be carrying state of Alaska minimum limits on your personal auto. And so that's a perfect example where someone may take something the state mandates or dictates and set their limits and what they carry based on that, and not based on what the actual risk level is. So, keep that in mind when you're making these decisions, that they should be based on risk, not necessarily what someone else is telling you need to have. Selecting insurance coverages, limits, and deductibles should be a response to risk and what your organization's appetite for risk is. And sometimes that's a good question to explore, because a lot of times I think organizations don't necessarily define what their appetite for risk is. That may be driven by principals or a small ownership group, and they may have their own ideas. But ask yourself that question: what is my organization's appetite for risk? Are we conservative? We want to move slow, maybe have a slower growth model, but make sure we're protected? Or are you one of the people, or your organization, willing to take some additional risk, more than what normally might be taken, with the hopes of achieving greater profit figures and those kind of things? So knowing what the organization's appetite for risk is going to guide sometimes these insurance questions, what programs you have in place, what you might consider risky or not when you're reviewing contracts. So that's a good one to explore. And then there's some other factors. These are factors again, and should be taken into consideration, but they shouldn't by themselves mandate what you do for your insurance program. And so I mentioned the licensing requirement. The state of Alaska may say, okay, to be a licensed contractor, you have to carry, 500,000. Well, 500,000 in liability limits may not be enough for your organization, or it may not make sense. And so you may want to carry higher limits. Don't let the licensing requirements dictate that. Sometimes licensing requirements might have limits that are mandated. Sometimes they may not. Here in Alaska, you have varying levels of license requirements. You have a state license, and then some of the local munis and government entities have their own licenses. If your organization does work outside of Alaska, those may vary greatly too on what the licensing requires. I think last time I looked, the state of Colorado doesn't even have a state license mandated, but a lot of the local cities and or government entities do require it. So knowing the license requirements, but again, not letting that dictate what you carry. Permit requirements, same thing. What insurance are they requiring in those permits? And keep one general practice in mind. When somebody puts together a set of insurance requirements and sends that to you, and you have to meet that insurance requirement, keep in mind that they're coming at it from a point of view where they're looking to protect their organization. They're not necessarily looking to protect your organization. And so those requirements may have some valuable information, and there may be cases where you need to meet those requirements, but don't think that those requirements are necessarily looking out for your best interest. So you got permit requirements. You have obviously contracts, which we're talking a little bit about today, and what those mandate, and those can vary greatly. You have, your federal, your local government, state, muni contracts. You have private entities. Some of you may subcontract for other organizations, and so it's very likely you could see dozens of different contracts throughout the year, and reviewing those in conjunction with your insurance broker and your attorney is a valuable risk management tool. And then leases. Again, a lot of times the lease agreements are set up to protect the lessor's interest, not necessarily yours. So if you're renting a piece of equipment, or if you sign a contract to have some property that belongs to someone else, they may mandate things in there that you cover a certain amount. And what they're mandating is that you're covering their interests, but that may not necessarily be the way you want to go. If you have a $50,000, or let's say you have a $200,000 excavator and you have $100,000 left on the loan, and all the loan company wants is you to cover their $100,000. If you do that and you go out and you destroy the piece of equipment, obviously you've got an unfunded deal on your hands there, where you're going to end up paying that out of pocket cost. So know what the requirements are in all these legal agreements, but don't let that necessarily dictate your what you're going to do in your decision making. And then availability in the marketplace. This is a good one, because having been doing this 20 years, I've seen a lot of contracts. I've seen probably darn near every contract in the state of Alaska, from private and general contractors, government entities, and I've seen a lot of contracts in other states. We have clients that work in Washington, Oregon, Arizona, all around the country. We've had people go to Virginia for federal contracts. So sometimes you have a great degree of difference in the sophistication level and the knowledge level of who is putting those contracts together. You have some organizations that are very refined. They've been doing this for decades. They know what they're doing. They have a legal team. They put practical insurance requirements out there. And then you have other ones that look a lot more like kind of just some stuff put together that sometimes makes you wonder who put this contract together and what's the rationale for it. We've seen firsthand where they will require things sometimes in a set of insurance requirements that are not available. Either they could be endorsements that you're being asked to provide and that those simply aren't available. It could be they want you to insure some obligation that is not even insurable. Like, you literally cannot get a product in the marketplace that's going to address what they're asking you to do. And so it's important to keep in mind who is writing the contract, or which organizations are issuing those contracts to you. What's their sophistication level? What's their knowledge level? And how credible is what they're giving me as far as meeting it? And then also too, when you're talking about availability, you also have to keep in mind that not only are the products available that you need to address the insurance requirements, but are they available at a cost that's reasonable? I've had a client come into my office one day about 5 years ago, and he was really excited. He came, he sat down, he dropped his contract on my desk. He just signed the contract. It's going to be a great job for him. We start digging through the insurance requirements of that contract, and he was looking at $16,000 in additional costs, and it wasn't that big of a contract. And $16,000 in additional costs for insurance that they were asking for in this contract. And I can tell you that this person did not have that cost built into their bid. They weren't prepared to pay that cost, and here they're sitting with a signed contract and obligated to provide this. And so that's another important service that your broker should be providing for you, is send those contracts in ahead of time, send them into your broker, send them into your attorney. The insurance broker can review those and let you know if there's any problematic insurance requirements, if there's any issues with the indemnification provision, if there's any endorsements or things that are going to have to be required to be secured, and if so, what your cost for that is, so that at the end of the day, you're able to identify, yes, we can comply with these insurance requirements in this contract, and here's what it's going to cost us to do that. We're going to build that cost into our bid. So then when you do get the contract, you can move forward with that. Another important piece of availability in the marketplace is also the timeline, because, you know, we live in a society where people want to drive up to the drive-through window and have what they want in 3 minutes. And in our world, things don't always move that quickly, especially in the current environment where you have a lot of folks working from home. You have the holidays, and so you really need to be cognizant of the timelines on these things. If you send over insurance requirements to your broker and your attorney for something that's bidding and 35 minutes later, your chances of getting the information you need are not going to be as prevalent. If you need a builder's risk policy, I might be able to just give you a quick wag on it and say, okay, that's going to cost you, $3,000 plus or minus. But there may be many other things that you need from those insurance requirements that are much more time-consuming process. Just for an example, professional liability or errors and omissions coverage, that's probably one of the slowest lines of coverage to quote when we send in applications out to market. It could be anywhere from 1 to 3 weeks. But if you're meeting that and needing a quote on that in order to fill a number for your bid, and you're coming to the broker 2 days before the bid, the odds that they can provide that information to you is minimal. So making sure to keep all the people in your team in the loop is important for making sure that whatever these contracts are going to require, you're going to be able to provide that. As the more experience you have in reviewing these contracts and working with your broker and your attorney, the better your ability is going to be able to assess it, look at for risk, how much is it going to cost, is it available? I mean, we have, contractors that have people in their office who have pretty good insurance knowledge. They've been doing it long enough to where they probably can come up with some of their own estimates on some of this stuff, or they've already locked it all in. So, but then on the other hand, you may have people at a different level who need to go through this process for 6 months or a year and do it multiple times before they acquire all the knowledge they need to be able to do some of those things themselves. So moving on to, well, I guess let me pause for a half a second and just see if anybody had any questions or comments on the part about what is going to dictate your insurance program.
So if anyone, this is Jody, if anyone has any questions and you don't want to be in a flurry to type it out, go ahead and just click the raise hand feature and I'll be glad to unmute you. Okay, Chris, this time I don't have any questions.
Perfect. Okay, great. And anyone's welcome if they think of something later to follow back up with us. I'm going to talk for a minute about contract parties and interest. And I kind of mentioned before that typically when someone delivers a set of contract requirements, it's to protect their interest. And this cartoon may illustrate that on some levels and with a degree of humor. Obviously, the guy is telling the other party that basically their new contract is going to be to cover everything. And I know sometimes if maybe you do subcontract work, you're a lower tiered subcontractor, you might feel like some of these contracts are putting all the risk on you. And so when we look at it, contracts allow parties to transfer the risk downstream to the party with the most ability to control it. And so what that means is that owner of that project is transferring a lot of risk through that contract down to the general contractor. And then the general contractor in turn is going to turn around and transfer risk through their subcontract with all of their tiered 1 subcontractors. And then those tiered 1 subcontractors may even have tier 2 subcontractors and on down, and they're going to continue that process of flowing these risks down to the party that has the most ability to control it. If you're putting drywall in a building, you probably have a lot better opportunity to control that risk than the owner does, who might be sitting in a different state. So this is a generally accepted practice that include things in the contract like hold harmless provisions, indemnification. They'll often require the upstream parties be named additional insured. They'll require upstream parties be given a waiver of subrogation. And so just know that the flowing down of the risk isn't because, this organization may, be trying to put everything on you. It's because you have the ability to control it while some of that risk is being put down. You're going to be responsible for it. The contracts between the parties will often protect the interests of third parties. So if you're a first-tier subcontractor and your general contractor gives you a set of insurance requirements, those insurance requirements are going to have protections in them for the owner. Now, you don't have a contract with the owner. You're not involved in a contract with the owner, but your contract with the general contractor is going to provide some protections for that owner, maybe the design professional, upstream contractors. And then typically those insurance requirements are also going to mandate flow down provisions to your subcontract. And so there may be things that an owner gives to you that you need to make your subcontractors aware of. And obviously doing that at the beginning of that negotiation process is important. You don't want to go to a subcontractor at the last minute before his bid and say, here's your insurance requirements. Oh, by the way, you have to provide us with a $5 million umbrella. Your subcontractors may be in the same boat that you are, where the more time that they have to get these kind of things lined up, better. And so be fair with your subcontractors. Make sure they're aware of whatever insurance requirements that they have to provide. One of the popular things that I see done is a lot of times the general contractor will take a copy of the insurance requirements that the owner is mandating on them, and they'll turn around and they'll forward that insurance requirement to their subs. Now, I get why it's done, because you want to give that subcontractor a general idea of what they have to do, but sometimes it's missing important information. And so if I'm the general contractor and I just forward the owner requirements, that owner requirement is going to say that owner needs to be named additional insured. Okay, great, we'll do that. But it may not say, it's not going to say anything about the sub needing to name you additional insured as a general. So you're passing them along something that isn't necessarily completely applicable because that's your contract. So my recommendation is always to have your own set of requirements of what you require from your subcontractors, and then amend that as needed. And the prime contract may mandate that the general provide a builder's risk on the project. Well, the subcontractors are covered under that. I send my sub a copy of the owner generated requirements. My sub may look at that and think they need to provide a builder's risk because it says right there in the requirements. So I think it's important for generals to be clear in their communication with subcontractors about what the sub's requirements are. Just sending them the owner's insurance requirements may give them some of the information, but it may not give them all the information they need. And then just to keep in mind, like I mentioned before, different levels of contractual sophistication exist. You're going to run into contracts where you may have some ability to negotiate the various provisions of those contracts. You can get involved, and then you may have some where you have no ability to negotiate them at all. This is the contract, either take it or leave it. And then you may have some contracts where you can get on the phone and talk to the party on the other end of the line and talk about negotiating some of these insurance requirements that are in the contracts. And you may have some that you can't get anything out of because every time you ask for something, it gets referred to their legal department for the next 3 weeks. And so understand that different contracting entities and owners have different levels of sophistication, and knowing those is important to making sure that you're signing on to something that you can work with. Often the insurance requirements a contractor may be presented with or included in the contracts that don't match up with the risk exposures. And what I mean by that is if I'm a big government entity, I may have one set of insurance requirements, and I may require the guy who's building a bridge for me to do those insurance requirements just in the same as I require the guy who's changing a light bulb. And so those are kind of boilerplate insurance requirements. And, we as risk management professionals, we like to see things that take into account the risk exposures. I don't like seeing my clients being required to provide coverages for things when there's no exposure, or being required to provide extraordinary limits when there's not really the exposure to justify it. One example would be Anchorage School District. If you want to do a roofing project for them, you have to put up a $5 million umbrella. And that may make sense when you think about the risk level. You have schools full of kids, and if a roof were to collapse, God forbid, 5 million might not be enough. And so you understand things like that. But where it becomes difficult is then you have somebody who's going in to replace a couple cracked tiles on the floor, and they're getting handed that same boilerplate template of insurance requirements with a $5 million umbrella. And that doesn't match the risk. We're changing out a couple floor tiles here. So I think it's important to know that a lot of times when you're given insurance requirements, it may be more of like a boilerplate, and it may require some negotiation on your part or asking about certain provisions. Maybe I don't need to provide the pollution. Ultimately, if this is done correctly, project owner is paying your insurance on these projects through your bid, obviously, but that project owner might be interested in saving $5,000 because he's not going to require a pollution policy from you when you're changing light bulbs or doing something along those lines. So understand that. We always say, everything is fine until a monetary dispute involves. And, over 20 years, we've seen some nasty breakups, some nasty situations where that person who may, frankly be your best friend could be sitting across the court from you a year from now. And, it doesn't happen a lot anymore, but we still come across situations we find where people are doing work without a contract. No hold harmless, no indemnification, no protection for getting paid, no dispute, nothing. It's a handshake contract. And, we understand why, because they obviously feel the relationship doesn't require it, but that's never a good idea. I would never recommend somebody do any amount of work without legal protections in place for their organization. And then again, making the point of have your contracts reviewed by insurance and a professional attorney. I'll get into a little bit. I'm going to skip and go to this slide. We'll talk real quick. We got about 14 minutes left, and I want to just go over, this is some actual contract language that we see in the insurance requirements that I just want to kind of go over an overview and talk about a couple of these things. This one right here is a simple form subcontract. This is just a standard template. It's something we saw not that long ago. And so when you start to go through it, one of the first things that you need to know when you're reviewing these insurance requirements is terminology. You can see where I've got public liability and property circled there in green on the top line. And, you have to know the terminology to be able to know what they're asking for. And the problem is that whoever puts together these insurance requirements may not always know the terminology, or they may be looking at a risk management book from 1982 that tells them we need to put this terminology in there. And so that sometimes there's terminology in these contracts that's outdated, that's irrelevant. Sometimes it's confusing. And so when I look at this, public liability, to me, that's general liability. That's what I call it, general liability. But some people call it public liability. Some might call it bodily injury and property damage. Some might call it comprehensive general liability. So you have various terms. So understanding what's being asked for is obviously important. And here, to me, they're asking for general liability coverage. They want to know you're protected if you're legally liable for causing bodily injury or property damage. And then you can see on the second line, it goes down to underline $1 million. So there it's mandating your limit. Now, I probably already have $1 million, so that's not a problem. But again, that $1 million requirement isn't going to dictate what I need to do to balance my risk. Maybe this is a really risky contract and we're really concerned about causing bodily injury. Maybe we're building a building right in the middle of the city with foot traffic going by. And so I may want to carry $2 million. Maybe I want an umbrella on top of that. I'm still satisfying my insurance requirement, but I'm making my decisions based on the risk to my organization, not based on what this contract's requiring me. And then when you keep going, then it goes down and talks about being additionally insured. I mean, I'm sure most people are familiar with that. You're basically providing legal protection to the other party in the event that you do something that gets them pulled into a lawsuit. Those are pretty standard in probably 99% of contracts and leases. Most of your contractor insurance programs out there are going to include endorsements for blanket additional insured. And so it may not be something you need to get additionally, but understand that that's usually in their standard part of contract. And one thing to mention too real quick is the way this language is laid out, I'm giving them additional insured status for my ongoing operations. So if I do something and get the owner pulled into a lawsuit while we're working on the project, the owner's going to have defense under my policy, and they should, because if I did something and was liable and got them pulled into a lawsuit, I should defend them. Now, the thing is to keep in mind is a lot of times that additional insured expires when the contract is done, but your risk exposure doesn't. If you're leaving behind a building or some kind of completed product, once that contract is done doing the work, you may no longer be additionally insured. Separate additional insured endorsement for that to include completed products and operations. A lot of contracts nowadays are mandating both of that. They want the additional insured to be for ongoing operations and for completed operations. There may be a cost involved to you. So again, identifying some of those and going there. If we go to the second page, then it's talking about your work comp employer liability limit that's required. You can see that spelled out there, as well as your commercial auto limit. They're mandating $1 million. And then the general liability limits are listed out at $1 million and at $2 million. This particular contract doesn't require an umbrella. It doesn't require pollution coverage. Those may be things that you want to carry if you have a risk in this. Don't let this contract dictate what coverages you carry and what your risks are. We go to the next page, and this is the last page of this contract. You can see in there they say professional liability insurance with not less than $1 million, $2 million. We see a lot of times professional liability being required in these contracts, and the contractor may have very little to no exposure. So that may be one of those provisions that you can get negotiated out by just explaining that we're not doing design work. We don't necessarily have a real big professional liability exposure. Let's get rid of that. Save you the $5,000 it's going to cost me. Cyber liability. That's one we're seeing more of in contracts and probably can expect to see more of it going forward. It's quickly rising up the ladder is one of the big exposures to businesses out there. I know everyone knows about the Matsu Borough and what they went through last year. In the last 2 months alone, we've had 2 nationwide insurance companies get hacked and their systems taken down. One of them for 3 weeks, the other one for about 2.5. And so it's definitely happening. And so it's important to know that. And certainly if you have a contract requiring it, that's something you're going to need to know about and make sure that that's appropriately. I circled the next section that says policies written on a claims made basis with 2 years of tail coverage. A lot of times these insurance requirements in the contracts, they require you maintain the insurance for X number of years after completion of the project. Important information to know. If this total contract has $20,000 in additional costs for me, and and it has a 2-year requirement that I carry after the contract's done, then that 20,000, I actually have to account for 60,000 in additional costs because I've got 2 more years of carrying this additional insurance. So making sure you understand how long your obligation is going to be to continue to comply with these requirements is an important part of it. And then the last section I have circled on there is the cancellation provision. This is a big topic just because the most typical thing that we see is owners and contracts wanting to be notified if your policies get canceled. And a lot of insurance companies will not provide that. They say, hey, your contract with this owner doesn't supersede our contract with you in the form of an insurance policy, and we're not going to provide that. Or we're going to provide that, but in accordance with Alaska state statute, which says 21 days for notice of cancellation or 10 days for non-pay. So you may have an owner asking for a 30-day notification, and essentially what that is they're telling the insurance company they have to get with them for permission to cancel the policy. And so insurance companies aren't real anxious to jump on that. This cancellation provision becomes a point we point out quite a bit, and hopefully, you know, they understand that and will negotiate with it. Usually what we try to do is get the language of the cancellation provision changed so that it puts the obligation on the contractor. The owner has a contract with you, not with your insurance company. And so you get canceled, they can contractually obligate you to let them know, but to obligate your carrier is another story. Some might do it, some might not. But you may run into issues there. So be aware of what the cancellation provision says. And then just here on the next page, it's showing that in this case, when you provide your proof of coverage, they want copies of the actual endorsements attached to them. Well, you just had to add it. It may be 3 weeks before the insurance company gets your broker an actual hard copy of that endorsement. So maybe one of those things you gotta, hey, we'll send you the certificate of insurance now. We'll follow up in a couple weeks and send you the hard copies of the endorsements. Or if you already have it on there, they can be sent right away. And then this finally comes through with an endorsement to waive rights of subrogation. We're getting close to tying it up, but one thing I'll say about waivers of subrogation is that the International Risk Management Institute, or IRMI, if you're ever looking for a good resource on risk management, check them out. IRMI, International Risk Management Institute, best practices recommends resisting waivers of subrogation when at all possible. There may be contracts where you have no choice. For example, the Muni of Anchorage may require waivers of subrogation on the work comp, and you have to provide that or you will not contract with them. But it also shouldn't mean that you just automatically give those out. I mean, it doesn't hurt sometimes to push back or try to negotiate some of these provisions. I don't like waivers of subrogation. Essentially what a waiver of subrogation does is it prevents your insurance company from going after another party if they're later determined to be responsible. My quick example is you sign a contract with the Muni, you send your people over onto the job site. Here comes the Muni inspector in his car and he runs your employee over. Your employee has medical expenses, your workers' comp steps in and pays all the medical expenses, and normally your work comp would turn around and subrogate that against the Muni auto policy because they caused it, they were liable. But with a waiver of subrogation in place, now you can't subrogate that claim, and instead it's stuck on your record. And anyone who's been around for a little period of time understands what loss history on workers' comp can do to your premium through your E-mod rating, can drive up your premiums. It can get you kicked out of markets. So you're sustaining these losses on your record for something you literally had no legal liability in causing. And so I don't like waivers of subrogation. I really don't like them on the work comp. There's cases where you can get them waived, and then there may be other cases where you cannot. And then I'm going to go ahead and jump through here real quick. So there's some of the trends that we see. We're seeing increased requirement of workers' comp. Even if you're an owner operator and you have no employees, odds are because of House Bill 79 that got passed last year, where pretty much everybody now requires workers' comp. I don't care if it's state says you don't have to have it. Our best practices recommendation is for all of our contractors to require work comp from any subcontractors. No waivers. In the past, sometimes people sign waivers thinking, nope, have a work comp policy. They can get one very affordable, and it's going to give you a level of protection and help you out when you get audited on your policies. There's an increased requirement in cyber coverages. That's something that you're going to continue to see. So understand what your cyber coverages are and make sure it's set up to protect your organization. There's an increased requirement for that additional insured to include the completed ops and products. We've talked about that a little bit. And then there's increased requirement for pollution coverage. And I think you'll see some of that on a greater scale too, where you may have to provide more of that evidence going forward. And so I'll kind of wrap things up here, and hopefully you got a little bit of information. The main points are just making sure that you understand that your organization has to manage risk based on your risk, not based on what's in these insurance requirements. But you are in a unique industry that you do have to review these requirements. You do so with your broker and your attorney ahead of the bid. Give yourself adequate time to get proper cost allocations made on what some of this would do and the availability of it. When you're going through your contracts, identify those problematic requirements and negotiate provisions if you have the ability to do that. Your ability to make the case may make all the difference in the world, whether you get that provision stricken or not. And then, ultimately determine whether it makes sense for your organization to move forward with this contract and this bid and this risk. Not all contracts do. So I'll kind of wrap it up there and turn it back over to Jody. Anyone's welcome to get a hold of me anytime if they have any questions or want any documentation or more information on any of this.
Thanks, Chris. A lot of information, a lot of things to think about, absolutely. And I also think it's kind of one of those things that a lot of businesses, once they set their general insurance, they don't think about it again. They don't look at it on an annual basis. They're not looking at it on a project basis. And a lot of them are missing opportunity to correct that. So
yeah,
a lot, I know that single word, yeah, covers. There's just so much that we take for granted thinking that it's done. One of the things my dad used to always say is, you plan for all the various opportunities, and once you have your plan in place, then you can forget about it because you have things covered. And that's one of those things with insurance where we think we have it basically covered and then walk away.
yeah.
So do we have any questions? Delta says, great presentation, thank you. Anyone else? So Sean would like to know, Chris, can you briefly explain what a hold harmless clause is? Good question.
Yeah, so basically the hold harmless clause is a section of the contract where they're basically pushing the risk into the other party to hold them harmless in the event of bodily injury, property damage were to occur. Here's one example I'll use to illustrate that. We have a number of guys who do snow removal, pretty standard activity for Alaska. Sometimes, it gets a little riskier when you're doing snow removal at a shopping center or even at a hospital. We had a contractor who had the snow removal for a hospital, and because hospitals have lots of people, and sometimes they're little old ladies, sometimes they're mobility challenged folks, and they may slip on the ice and fall and hurt themselves. Well, of course, if somebody does that, they're going to tender their claim or their suit to the hospital. But the hospital's got a contract with the snow removal contractor that the snow removal contractor holds them harmless and indemnifies them for bodily injury. So that claim turns around and gets tendered back to the snow removal contractor. So if I'm removing snow in a hospital, I'm assuming all of that premise risk in the event anybody has a bodily injury because I've signed a contract that includes the hold harmless provision for the hospital. So it's a way to transfer that risk and put it on the party with the ability to control it. But it's important to know that, obviously, if you are giving another party hold harmless in that contract.
So Chris, let me ask a follow-on question to that. Is that something that you can usually negotiate with the owner, or if it's a prime to a sub?
No, not typically. I mean, that it's just a generally accepted best practices that that's the way you put the risk on the party who has the ability to control it, is through that hold harmless. And I mean, I wouldn't say that there's never been a contract that's been done that didn't include a hold harmless provision, because I've actually seen it. But it's a pretty standard part of the bulk of your contracts, and it's going to be in there. So yeah.
Thank you. Any other questions, Sean, Delta? So Delta says no more questions for her. It's most likely one of those things that's like me. I have to let the information kick around in my brain, and then after the event closes, suddenly I have several questions that I wish I would have asked. So if that happens to you, and if you have any questions, Delta, Sean, I will, and everyone else that attended, I'll go ahead and email you the slides. I didn't upload them today, so I apologize for that. Sorry about that, Chris. I'll go ahead and email you the slides so you have these notes, and I can include Chris's contact information. You also have the webinar invitation, so if you think of anything, you're welcome to send me those questions, and I'll be glad to forward those on to Chris on your behalf. So by all means, the point here is if you have questions regarding your insurance and you're coming across in that potential risk management of a new contract or a new agency or a new prime, feel free to reach out to either PTAC or Chris. Let's get those questions answered so that then you're making the strongest business decisions you can moving forward. So Chris, any final comments?
No, I appreciate the opportunity. I think, you know, everybody listens to an hour presentation. It might take one or two things away, which is, you know, the hope. And I hope everyone just understands that my main point is your insurance requirements, what policies you carry and what limits you carry, should be dictated by the risks that face your organization. Yes, you may need to amend them to meet certain contracts, but don't let contracts and outside parties determine what you're going to carry.
Thank you. That's a good closing comment. Well, I'm going to officially do a last call for questions. And if you can't type quickly, feel free to raise the hand. Well, at this point, I don't see any additional questions. So Chris, thank you so much for giving your time and effort to be here today. I truly appreciate it. PTAC really appreciates all of your expertise and your willingness to present on behalf of our program. And attendees, thank you so much for joining us this afternoon, and keep an eye out on our website for future opportunities. And hopefully, Chris, I can talk you into presenting again. So at this time, thank you, everyone. I'm going to go ahead and officially close out the webinar.